Kurt Nelson, though, founding partner, CEO of Summerhaven Investment Management. Kurt, good to have you with us. You could probably hear it in my voice. That chart gets me excited, to say the least. I mean, you know, if you're a technical technician as I am, this is really just right in our wheelhouse. But talk to me. What's behind the bid here? You've got the dollar coming off. You also have geopolitical tensions, which have been mounting. Yeah, you nailed it, Ben. You're right. I think that it's fun to see you excited about a trade and about a commodity, and I think it's well-founded here in gold. There's a few things going on. I liked your picture going back, several months in gold and seeing these different support levels. But if you even go back further and look at a big picture back to the beginning of the decade, we saw gold kind of push hard from 1,500 to 2,000 during the first 6 months of COVID. And in the last 4 years until we broke out above 2,100, we saw a pretty, a fairly large range, but essentially a range-bound sideways market in gold for several years. And now we've broken out to all-time highs. We've got the pretty important psychological level of 2,500 in sight. So why is that happening? Well, there's a few reasons I think behind it. One of them is the lower interest rates. The fact that gold is an alternate store of wealth to dollars. If you're earning less interest on your dollars, then the cost of holding gold on an opportunity cost basis goes down. In the beginning of 24, remember that we had surprises to the upside in inflation. We ended last year expecting somewhere between 4, maybe even 5 rate cuts during 24, starting in March. That did not happen. And we had gotten so conservative in our estimates, economists, Wall Street, that we thought maybe there'd be no cuts at all in 24. Well, one of the things that the Fed and Chair Powell have said is that they're going to follow the data. And the data has been supportive for rate cuts in the last 3 months. Inflation data has surprised to the downside. I think the Fed is feeling much more sanguine about the ability to cut rates. And we'll probably see that, probably 2 cuts in the end of 24. What that means is it's supportive of gold. There's a couple other factors I'd like to mention. One is that, you mentioned the risk-off kind of fear trade. There is a decent amount of tension coming into the second half of 24. It's a pretty critical presidential election cycle in the U.S., which will have not just national but international implications. Could affect foreign policy in a big way. We've got a number of geopolitical tensions in the Middle East, continuing in between Russia and Ukraine, that are in flux and threaten stability. And gold benefits from all of that underlying tension. Yeah, I like that. There has been a fair amount of uncertainty out there, and that's quite the long list that you provided us in terms of contributing factors to this rally. Let's take a look. Per your request, longer term, I've got it going all the way back to, it looks like 06 here, balance around 625, 850, 1600. You can see some of these stocks along this trajectory to the upside. 2024 inflation surprises, you mentioned, cuts that didn't come to fruition ultimately. And in a very counterintuitive fashion right now, we heard about the PBOC, that they weren't apparently, the last couple months, they haven't bought gold and added to their supplies or the reserves ultimately. So that, kind of, I felt like could derail some of the momentum. But here, proof positive, Kurt, of what we always say. I mean, price is king. That's right. That's right. I think with central bank buying is maybe another kind of under the radar support for gold over the next year or two. And the reason why is it's an alternate store of wealth for individuals, but it's also an alternate store of wealth for central banks. And the dollar's been the reserve currency. It's been and that form of savings usually at central banks is in the form of treasuries, which you require U.S. dollars to purchase those. What we've seen, for example, with Russia is that their sovereign assets that are denominated in dollars are at risk of seizure by the U.S. If they end up on the wrong side of U.S. policy, we could seize those assets and they're no longer safe. And gold is immune to that. So you don't have to worry about if you're in euros or in yen or in dollars and you get on the wrong side of that nation state. If you're in gold, you're just in gold. It's it's indifferent to that geopolitical kind of financial intervention. So
we have seen a building of gold deposits at central banks. And I think there's some prudence to that because we don't know who's going to be on the wrong side of the next president. And if you want to have security, it makes sense to move a little bit from dollars into gold at the central bank level.
I feel like sometimes, Kurt, in markets, you could, blindfold yourself, spin around 10 times, put a dart in my hand. I was jokingly saying I'll throw it and hit something bullish. Gold's one of those markets right now. The indices as well. I mean, some of these individual stocks that we've been covering. But talk to me about crude right now, a little bit more sideways, right? There was some concern as it ran up towards near those April highs, up around 87, but kind of stalled out again. And it's pretty comfortable right around this $80, $81 level, I feel like.
Yeah, I think it's found a home. I think the good news for oil is that it's supported here. We have quite a lot of domestic production, and I think OPEC has shown resolve at maintaining cuts and supporting the price. I think they're happy with an $80 barrel price level. I don't expect it to run a lot higher because that's one of the as we're in this kind of second half of the year coming towards a November election. We saw, say, for example, during the midterms in 22, reduction of the Strategic Petroleum Reserve. I think to help combat some high inflation that was generating political concern, and I don't think so. The SPR hasn't really been recovered to its prior inventory levels. So that's not really available in the way it was to relieve pressure there. But I think that the Biden administration and Congress, frankly, politicians in general, are not going to want something as obvious as high oil prices and high gas prices to affect their chances in November. So I have a feeling that we're probably going to see a largely sideways market in oil. But again, this geopolitical tension risk premium applies to oil in particular because we have not seen a discontinuation of the military action in Gaza by Israel. That's still as intense as ever. The northern border with Hezbollah continues to show, artillery fire, artillery shells going across back and forth, strategic, tactical, bomb runs into, parts of Syria or northern Lebanon by Israel in retaliation. That is still a powder keg that could stoke very high prices quickly in oil. I don't see the flip side. It doesn't seem like an even-sided coin. I don't see something that's going to take oil to $50 a barrel in a short period of time, but I can imagine it going to 100.
Russia-Ukraine tensions could potentially provide one of those catalysts to 100. I did hear Trump administration talking about easing some of those oil constraints for drillers here in the U.S. So lots to keep an eye on that front as well. Kurt, thanks for joining us. Thanks for sharing part of your Wednesday. Kurt Nelson, founding partner, CEO of Summer Haven Investment Management.